I used to know this old guy, and every morning he would go to the bank and withdraw all of his money, the full balance, and then carefully count it, and then deposit it back into the bank. He did this every morning because he didn't quite trust the bank. He was worried that they might lose his money. Now, in his mind, he thought the bank had a little pigeonhole labelled "your money," and the bank would put this old guy's money in that pigeonhole separate from everyone else's money. Now, that's not how banks actually work, but he thought it was like a self-storage business. The kind of business where you can rent a little box and put your furniture in there. And if the self-storage business tries to swap your couch for somebody else's couch the same colour, well, they're not supposed to do that. And you have your stuff in your box. At law, that sort of arrangement is called a bailment. It's where you store somebody else's stuff and you're obliged to return their stuff when they ask for it back. Another example of a bailment is valet parking. You go to a fancy restaurant, you give your car keys to some young person wearing a velvet jacket, and hopefully they take care of your car while you eat. And when you finish your meal, you come back out and somebody drives up your car. In a bailment, they're supposed to bring back your car. They can't just say that it's another car of the same make, model and colour and that's close enough. In a bailment, they have to bring back your exact car, no substitutions. Banks are not bailments. This was confirmed by a law case back in 1848. So when you deposit money in a bank, the money that you give the bank, it's now the bank's money. They have title to your money. And you are simply an unsecured creditor of the bank. Now, what does the bank do with your money? Well, they pool it with the deposits of other customers, and then they try to profit from that pooled fund of money, perhaps by lending it out to borrowers at interest, or perhaps by buying government bonds that pay interest. Now, for many savings accounts, the bank will share some of that profit with you, the depositor, so you make a little bit of money. But most of that profit goes to the bank's shareholders. We say that the assets have been dematerialized. The bank has title to your money, and the depositors do not have title to their money. Now, the system works quite well because it makes it very fast to transfer money. They don't have to find your cash in a particular pigeonhole and move that physical cash to another bank in their pigeonhole for their customer. Because the money is pooled, banks can simply have ledger entries where they keep track of how much money is being transferred from one bank to the other. We have what we call a clearing house or a clearing system, where the banks simply add up the transactions, and if there is any net imbalance, they simply do an electronic transfer of that net difference. So it means cash transfers are very fast. The only downside is that occasionally, when a bank lends out money to borrowers, the borrowers don't pay the money back, and maybe the bank goes broke. You remember the 1946 movie It's a Wonderful Life, starring Jimmy Stewart? That's a big plot element of that movie.
Look, we're still in business. We've still got $2 left. Well, look, let's have some of that. Let's celebrate. Get some glasses, Tilly. Well, a couple of financial wizards.
Those Rockefellers.
So banks do occasionally go broke. I used to work for the ancestor company of Protagonist Therapeutics, and they lost $16 million when Silicon Valley Bank went broke last year in 2023. In the modern age, most governments have some sort of insurance scheme so that if your bank does go broke, the depositors will get refunded. In the United States, the FDIC, the Federal Deposit Insurance Corporation, will cover depositors' losses up until the first $250,000. In Australia, we have APRA, which also covers losses up to the first $250,000. When Silicon Valley Bank went broke and Protagonist Therapeutics lost $16 million, President Joe Biden ordered that all of the depositors be bailed out in full, not just the first $250,000. So Protagonist Therapeutics got their full $16 million back, even though the bank had gone broke. So that works okay for banks, but it turns out that something similar happens for other assets like stocks and bonds. So back in the old days, up until the late 1960s, stocks were physical pieces of paper. They were stock certificates. Very nice, fancy printing, but they were like cash. When you owned a stock, they mailed you the piece of paper, and you would keep that piece of paper somewhere safe in your house. If somebody broke into your house and stole that piece of paper, it was like stealing cash. It meant that you didn't own the stock anymore, and whoever owned the piece of paper owned that stock. So that system worked reasonably well, but by the late 1960s, they had what they called the paperwork crisis. At the end of every trading day, they had to transfer millions of physical paper stock certificates from the seller to the buyer. And that was an enormously complicated and time-consuming and expensive job to do. And as the volumes of share transactions were going up, they were concerned that the cost of moving physical share certificates would only go up. And they looked over at the banking industry and said, why don't we do something like what banks do with electronic transfer and pooled assets? And so it took some time, but by 2005 in the United States, all assets were now dematerialized. That is, when you buy shares through a share broker, the way that works is that the broker has title to that stock or bond, and you are simply an unsecured creditor. All of the customers' stocks and bonds get pooled by the brokerage firm, and then that simplifies transferring assets to other brokers. Like banks, they can simply have a clearinghouse and they only have to transfer the net change, and then it's done on a ledger instead of moving physical paper certificates. So that works well. We get fast, cheap brokerage, we have online brokerage websites, and everything works very well. The only downside is that the brokerages can use the customer's stocks and bonds as collateral for various complicated deals by which the brokerage tries to profit. Unlike banks, the brokerage doesn't share any of that profit with the customers. Brokerage houses generally don't pay any sort of interest. They might use some of that profit to reduce the brokerage fee though. So what do they use customers' stocks and bonds as collateral for? Mainly for derivatives. So derivatives are a little bit like insurance. Imagine a baker is afraid that the price of wheat will go above a certain price. They can essentially buy an insurance policy so that if the wheat does go above a certain price, then the baker can buy wheat at a predefined price, and they don't care if it goes above that price. And if the price of wheat doesn't go above that price, then the baker has lost the premium they paid, just like any other kind of insurance, if you don't have an accident and don't need to use it. So this works fine, but it means that the brokerage house that is selling these options, they need some assets to use as collateral just in case things do go higher and they do have to pay out. For the example of wheat, that means that if they have a stock of wheat and the price of the wheat goes up, they're covered. They have a bunch of wheat and the wheat is now very valuable. So the brokerage houses are basically invested up into the hilt using customers' stocks and bonds as collateral for various derivatives deals. So that all works perfectly well. The only problem with this is counterparty risk. So if a broker makes a deal with another broker with derivatives, it all depends on the other broker paying up when they are supposed to pay up. Otherwise, the original broker is out of pocket. In a future financial crisis, you could have a bunch of brokers go down like dominoes, and as each one goes broke, they can't pay their obligations to the other broker, and then that broker goes broke as well. So that happened back when Lehman Brothers went broke. Lehman Brothers was the bank that went down and brought about the 2008 global financial crisis. Now, one small part of the Lehman Brothers bankruptcy was that of their many derivatives deals, one of those deals involved JP Morgan Bank. And so JP Morgan, quite rightly, seized the assets, the stocks, of the Lehman Brothers customers who had used Lehman Brothers as their brokerage to hold their shares. Lehman Brothers had used those shares as collateral in a derivatives deal with JP Morgan, one of many derivative deals. And when at the end of the deal, when Lehman Brothers couldn't pay the money they were obligated to pay, JP Morgan seized the shares that would have belonged to the Lehman Brothers customers. And this came up in the bankruptcy trial, but the judge ruled that the 2005 laws now mean that when that happens, JP Morgan is within its rights to seize as collateral the assets of the customers of the counterparty, if the counterparty can't pay up what they're obligated to pay in that derivatives deal. So that's been confirmed by case law in that Lehman Brothers case. So what that means is that today, if you own shares or bonds or other financial assets through a broker, if, heaven forbid, there were to be another financial crisis and your brokerage went bankrupt, then your assets are most likely going to be seized by the counterparty bank in order to cover the amount of money they should have been paid by your broker. And heaven forbid, if the financial contagion spreads and all the brokerage houses go broke, it's unclear what would happen to everyone's assets. This doesn't just affect you if you own stocks and bonds through a broker, but it also affects every other asset holder, such as pension funds, who are not their own broker-dealers, but instead own those stocks and bonds through a broker-dealer. It's a little bit like buying a car from a car dealer, and you pay the amount in full, there is no debt owing on the car, and you drive it around. But the car isn't actually owned by you. The dealer still has the title to the car. And then they use your car as collateral for complicated derivative schemes about cars. But you still get to drive your car around. And if, maybe one day, that dealer goes broke because their complicated derivatives deals made them bankrupt, then that means that somebody can show up with a spare set of car keys and take your car. And say, well, now the car belongs to JP Morgan because your dealer that had title to your car, they went broke. Thanks very much. And then you're in a line with all the other unsecured creditors. Similar to the FDIC for banks, various governments do have funding schemes for brokers, so that if you lose your stocks or bonds because the broker went bankrupt, there is a fund that will maybe bail you out. In the United States, this is called the SIPC. And unlike the FDIC for banks, the SIPC is not a US government agency. It's simply an organization established by US law, and all the broker-dealers are required to pay a small fee in order to have a fund. But if all the broker-dealers were to go broke in some future financial crisis, then the SIPC will not have enough money to bail out all of the creditors. And because it's not backed by the full faith and credit of the US government, chances are they won't have enough money to refund the depositors. Now, some people think maybe there should be some sort of scheme like the FDIC, which is funded by the full faith and credit of the US government. But at the moment, it's not. I personally think a government insurance scheme won't work. The reason is that the whole derivatives complex is now about 10 times the size of the world's GDP. So there's no way that governments can pony up enough money to refund all the losses if there was a financial crisis that brought down the whole derivatives market. It would be like the government giving you a tax bill of $50,000 so that they can refund you the $50,000 that you lost when your brokerage went bankrupt. So your assets have been dematerialized. The stocks and bonds you think you own through your broker, you don't own them. The broker has title to those stocks and bonds, and the broker uses them as collateral for complicated derivatives deals. And if, heaven forbid, your broker goes broke, or if a counterparty to a derivatives deal goes broke, then your stocks and bonds can be seized by the party that was expecting to be paid. And that takes precedence over other bankruptcy proceedings. And the law was confirmed in the case of the Lehman Brothers bankruptcy.